Riches are rarely built overnight. Most wealthy investors grow their wealth gradually over years, following consistent strategies and disciplined planning. Understanding the difference between long-term and short-term investment strategies is key to choosing an approach that fits your goals, temperament, and lifestyle. Let's start with long-term strategies, which are often considered the backbone of wealth building. The most common form is buy and hold. This approach means purchasing investments such as stocks, index funds, or ETFs and holding them for years, even decades, regardless of market fluctuations. The goal is to let your investments grow over time and benefit from compounding. Index funds are particularly popular for long-term investing. They track a market index, like the S&P 500, and automatically diversify across hundreds of companies. This reduces the risk of any single stock underperforming your portfolio. Historical data shows that despite occasional market downturns, broad indices have consistently increased in value over the long term. For instance, the S&P 500 has historically returned an average of around 7% per year after inflation over multiple decades. Compounding is a critical concept here. By reinvesting dividends and allowing your investments to grow, even small, regular contributions can snowball into substantial wealth.
Imagine investing $200 every month into an S&P 500 index fund. After 30 years, assuming a 7% average annual return, your total contributions of $72,000 could grow to hundreds of thousands of dollars.
This is the power of consistent, long-term investing. Your money is working for you while you focus on your life. You can think of long-term investing as planting a tree. You water it consistently, give it time to grow, and eventually, it bears fruit year after year. You don't see instant results, but over decades, the growth is substantial and enduring. Long-term strategies also offer lower stress compared to active trading. Because you are not reacting to daily market changes, you avoid the anxiety of watching prices fluctuate hour by hour. You do not need to guess the right time to buy or sell, which is often impossible even for professional investors. Patience and discipline are your most valuable tools here. Another key advantage is cost efficiency. Long-term investors typically incur fewer trading fees and lower taxes, especially if they invest in tax-advantaged accounts or hold investments for more than a year. By minimizing transaction costs and capital gains taxes, more of your money stays invested and compounds over time. Let's look at some practical steps for long-term investors. Choose broad, diversified index funds or ETFs that match your goals and risk tolerance. Avoid the temptation to pick individual hot stocks unless you have significant experience. Set a consistent contribution schedule, weekly, monthly, or quarterly. Consistency is more important than timing the market. Reinvest dividends to take full advantage of compounding. Review your portfolio periodically. Once or twice a year is usually enough. Adjust allocations only if your goals or risk tolerance change significantly. Stay the course, ignore short-term market noise, and focus on your long-term objectives. Long-term investing also provides a buffer against volatility. While markets fluctuate in the short term, over longer periods, downturns are often followed by recoveries. Consider the 2008 financial crisis. The S&P 500 dropped dramatically, but investors who held their positions for the next 10 to 15 years saw strong gains. This illustrates that long-term investing smooths out short-term volatility and rewards patience. Long-term investing is ideal for individuals who have multi-year or multi-decade goals, like retirement or funding education, prefer stability and lower stress, avoiding daily market monitoring. Value compounding and disciplined, consistent investing are willing to ride out market volatility rather than react impulsively. In the next part, we will explore short-term strategies, which offer potential for quick gains but come with higher risk, more stress, and a greater time commitment. Understanding both approaches will help you decide which strategy aligns with your personal goals, financial situation, and personality. Now that we've explored long-term investing, let's look at short-term strategies, which focus on quick gains from market fluctuations. These approaches involve buying and selling assets rapidly, often within days, hours, or even minutes, to capitalize on small price movements. Day trading, for instance, involves opening and closing positions within the same trading day, aiming to profit from intraday price changes. Swing trading, on the other hand, seeks to capture gains over a few days or weeks by identifying and riding market swings or trends. The rise of cryptocurrencies has also opened new avenues for short-term speculation, with their inherent volatility attracting many traders. While the allure of quick profits is strong, short-term investing comes with significant risks. Market volatility, rapid price changes, and the need for constant monitoring can lead to substantial losses if not managed carefully. Unlike long-term strategies that ride out market downturns, short-term traders must react swiftly to avoid significant capital erosion. The rewards, however, can be substantial for those who master these techniques, offering the potential for high returns in a short time frame. Successful short-term traders often employ sophisticated technical analysis, chart patterns, and indicators to predict future price movements. They also rely heavily on market news and events, as these can trigger immediate and significant price reactions. Risk management is paramount, with strict stop-loss orders and position sizing crucial to protecting capital. Let's compare short-term and long-term investment strategies to highlight their key differences. Short-term strategies prioritize quick gains from market fluctuations, requiring frequent trades and constant monitoring.
They involve higher risk due to volatility and demand significant time commitment for research and execution.
Long-term strategies, conversely, focus on gradual wealth accumulation through sustained growth with infrequent trades. They typically involve lower risk, relying on market resilience and compounding returns over extended periods. The time horizon for short-term is days to weeks, while long-term spans years to decades. Short-term strategies require active management and quick decision-making, often driven by technical analysis. Long-term strategies, however, favor passive management and fundamental analysis, focusing on a company's intrinsic value. Both strategies have their place in a diversified portfolio, depending on an investor's goals, risk tolerance, and available time. Understanding the nuances of each is crucial for making informed investment decisions. Whether you prefer the fast pace of short-term trading or the steady growth of long-term investing, careful planning is key. Thank you for watching, and remember to always conduct thorough research before making any investment.
Now that we've examined long-term and short-term strategies individually, let's compare them practically to see how they fit different investor profiles.
Consider two investors. Alice prefers a long-term approach, while Bob focuses on short-term trading.
Alice invests $200 monthly in an S&P 500 index fund, holding her investments for decades.
She experiences minor fluctuations along the way, but over 20 years, her portfolio grows steadily, benefiting from compounding and dividend reinvestment. Alice rarely checks the market daily, enjoys peace of mind, and steadily builds wealth toward her retirement goal.
Bob, on the other hand, engages in short-term trading. He buys and sells stocks or cryptocurrencies within days or weeks, aiming for rapid gains.
Some trades are profitable, others result in losses. He spends hours analyzing charts and news, experiencing high stress and emotional ups and downs. While Bob could make significant money in the short term, the risk of losing a substantial portion of his portfolio is much higher than Alice's approach. This example illustrates key differences: stability versus stress, patience versus active management, time versus immediate results. Both strategies can be valid, depending on personal goals, risk tolerance, and lifestyle. A practical tip for beginners is to consider a blended approach. Even if you prefer long-term investing, allocating a small portion of your capital to short-term opportunities can provide excitement and additional potential returns without jeopardizing your core portfolio. For example, you might invest 80% in long-term ETFs and 20% in speculative trades or cryptocurrency. This allows you to explore short-term gains while keeping most of your wealth protected. Visualizing this over time, consider the S&P 500 over 20 years. A long-term investor sees steady growth despite occasional crashes, recovering and increasing wealth gradually. Meanwhile, a short-term trader may experience wild fluctuations. The potential for gains is high, but losses are equally possible, and the emotional toll can be significant. Another important point is fees and taxes. Long-term strategies typically incur fewer transaction fees and lower capital gains taxes, especially when holding investments for more than a year. Short-term trading involves frequent transactions, increasing costs and reducing net returns. This is a practical consideration that beginners often overlook. When deciding your strategy, ask yourself, what are my financial goals? Retirement, wealth accumulation, or short-term income? What is my risk tolerance? Can I handle market swings without panic? How much time and energy can I dedicate to managing investments? What is my personality type? Do I prefer calm, steady progress, or enjoy active engagement and analysis? Remember, there is no universal best strategy. The best approach is the one that fits your goals, resources, and comfort level. Long-term investing builds wealth gradually with lower stress, while short-term strategies offer excitement and quick potential gains at higher risk. In summary, long-term strategies, patience, stability, compounding, lower stress, minimal active management. Short-term strategies, potential for fast gains, high risk, active management, stress, and time commitment. Blended approach, allocate most of your capital to long-term growth, with a small portion for short-term opportunities if desired. The key takeaway, your strategy should reflect your objectives and personality, not just market trends or what others are doing.
By understanding both long-term and short-term strategies, you can make informed decisions, balance risk and reward, and develop a plan that works for you.
Investing is ultimately about planning, consistency, and aligning actions with goals. Whether you choose a calm, patient path or a more active, high-stakes approach, knowledge and discipline will be your greatest assets.